Well, good morning, everyone. Today's topics quickly is what is the one beautiful big beautiful bill act? Individual tax rates we're going to talk about. We're going to talk about the changes, both permanent and short-term changes to deductions and credits. We'll talk to about estate planning and wealth transfer. We're also going to talk about tax breaks for businesses, investment incentive programs, other tax changes that aren't part of the One Big Beautiful Bill Act, and then we're going to have some Q&A and some closing thoughts. So, again, if you do have any questions along the way, just go ahead and send them in, and I'll be able to answer those at the end of the talk.
All right, so what is the One Big Beautiful Bill Act, or the OBBBA that you probably hear everyone referring to it as? This legislation was signed into law on July 4th by President Trump. It made many provisions of the prior Tax Cuts and Jobs Act permanent, and also made some additional changes on top of that. There's several new tax breaks included in the OBBBA. Deductions and credits, and we'll get into each of these in more detail. This is high level. There's a big individual impact, both in making permanent the 7 tax brackets that were set to change, basically. Also, some other additional deductions that I mentioned, things that several different folks will be able to take advantage of, just depending on your age and where you're at in your financial plan. And so the individual impact, it's going to vary. All right, we're going to get into those details, but there's a lot of moving parts in here, and they're all going to be very dependent on each person, each family's situation. And so it's obviously going to be important to talk with us further so that we can dive into you individually and figure out the best avenue forward for you, whether personal, business, whatever planning that you're looking at. So just to get into a little bit more detail, these are the 5 primary areas that covered in the bill and that we're going to touch on today. So as I mentioned, the individual tax rates, there are 7 brackets. Those were made permanent, so nothing is really going to change from that standpoint. It did increase the standard deduction. It is up to $31,500 now in 2025. It made permanent the child tax credit and also bumped it up to $2,200 per eligible child, and added another dependent credit of up to $500, which this could include, maybe an older parent that's living with you or someone that you're supporting in the household. It added higher exemptions for estate and gift taxes, which, this is a younger crowd generally on this particular webinar, but something to think about for the future. It also made permanent removing the tax penalty for not having health insurance. That was actually set to expire as well, and it is now permanent. There are some business changes as well that I'll just mention real quick in this section. The corporate tax rate was made permanent at 21%. That's from the 35% that it was lowered down to. That was going to expire. And also higher deduction limits for Section 29 expenses and other business impacts that we'll get into here in a later slide. Let's see. I'm going to let some of the other gentlemen here talk about the estate planning and then the investment incentive programs.
Yep, sure. So perhaps most importantly to everybody on this call, at the end of this year, if you've been working with us or Somnio CPAs, you've known that we've been talking about this for a few years now, where all of the 2017 Tax Cut and Jobs Act, I think that's what that was for. I know it was the 2017 tax code was set to expire, which really meant that for individuals, all of the tax rates were going to go up next year. Effective rates, brackets, everything. What was included in this bill is making permanent the current or 2017 legislation where the 15% tax bracket was reduced to 12. And all of those brackets are still adjusted or indexed for inflation. So if we go to the next slide, what does this really mean? It means we have certainty around what income tax bracket you're going to be in. So it makes it easier for forecasting longer term tax plans. If you're expecting big increases or big decreases in income, it's a great time right now to build and look at what that might mean for, do you fund a Roth or not fund a Roth? Do you save to your 401k on a pre-tax basis? Do you save to it on a Roth basis? If you know your income is going to be up next year relative to this year, you might want to consider that Roth. Then again, if you anticipate it going the other way, or you're retired, you're in the process of retiring, you might want to think about that differently. These are all circumstances that have to be dealt with on an individual basis. We get a lot of questions a lot of times around like, well, what is everybody else doing? Well, that doesn't really matter if we're talking about you and your loved ones and your household situation. What matters is what is important for your goals and your needs, and we're available to help you to do that. I say all this, there are a couple of things. Looks like most of the attendees are here in Kentucky. Just a reminder that the first $31,000 at the Kentucky level of distributions is typically exempt from state income tax. So there's that tool to consider that often goes unnoticed. And then there still is a really wide gap or difference between the 12% and the 22% federal brackets. A lot of the other jumps from one bracket to the next are 2 to 4%, but there is still that 10% jump when you go from 12% income tax bracket to 22. So it's something that we see a lot of people needing to plan around, because you can accidentally end up having a lot of your income tax at a much higher rate accidentally. So, Chris, I think you're back to my favorite discussion, deductions. How do we get rid of income?
Actually, I'm gonna chit chat about that if you don't mind for a little bit. So deductions and credits, there are some changes from the 2017 TCJA, or the Tax Cut and Jobs Act, but some things were eliminated and some have been limited to, the more popular deductions and credits. The idea is to simplify tax code, although I think that's relevant given that the tax code is always a little confusing. Anyway, but the OBBBA makes changes permanent, and then there's also some temporary ones. So just kind of look at some of them. Some of the highlights are that the deduction for a single is changed to $15,750, and if you're filing jointly, it's $31,500. That's effective as of January of this year of 2025. And each additional years, it will be adjusted per inflation, which is a nice change for us, that we're actually going to try to keep up with inflation. But increased in that also is the child tax credit, up to $2,200 per child. And same thing with future inflation adjustments. So next is the mortgage interest deduction, which is limited to the first 750,000. And then along those lines with the home equity loan, the interest is available for deduction the interest deduction is disallowed unless you use it specifically for home improvement, so improving the value of your home. And then they also have the clean vehicle and energy credits for both individuals and businesses after 2025. So that'll start January 1st of 2026. Some of the other ones that are more temporary of the changes that we're doing, or not we're doing, the bill is going to be doing is, but we'll be helping work through it, is that there's no tax on tips up to $25,000 per taxpayer, and that's from year 2025 through 2028. So that's a nice thing for people that are in the service industry generally receiving tips. There's no tax also on overtime up to $12,500 per taxpayer. Same thing from 2025 through 2028. I know we were supposed to be making this less confusing, but there are some changes, but they're also very helpful. But I'm going to keep working through these. But there's car loan interest, which is deduction for any new purchases of U.S. assembled passenger vehicles, and that's 2025 to 2028. I like the idea of that we're trying to increase both jobs and manufacturing here in the U.S. with the idea of this deduction. So. And then there's a standard deduction of 6,000, increasing it by 6,000 for seniors at 65 and older. And the last kind of temporary one that we are just looking at briefly is that it allows for itemized state and local tax, also known as SALT, deduction from 10,000 to actually 40,000. And that's an annual adjustment. And that's available from 2025 to 2029. Most of the ones I just mentioned were from 2025 to 2028. So then there's also some permanent changes to charitable deductions. First, it allows charitable deductions for non-itemizers for up to 1,000 for singles and 2,000 for joint. Secondly, it limits the charity deductions for taxpayers who itemize such those contributions, and they may only be deducted by 0.5%. So, and then the income and the tax benefit to those deductions is limited to the first 35,000 of your income bracket, 35% of your income bracket. So, depending on like how you give to charity, there's some great advantages that we would want to look at. And just depending on how you earn, what your income level is, some of these changes that they've made on the OBBBA is going to affect you a little bit or potentially a larger effect on your tax bill. So I would highly recommend that you work with your financial advisor and a tax professional to make sure you have a solid understanding of what the deductions and the tax opportunities are. Obviously, we have Somnio CPAs with Chris on the line, but we also are happy to work with your current tax professional if you prefer as well. Just want to make sure you guys are taking advantage of everything that you can be. So, another action item would be to use your temporary exemptions for short-term tax planning. And then just again, rethinking your charitable strategies to maximize the tax benefits of that. One example of that is you can give away appreciated stock that's been held for longer than 1 year to eliminate those capital gains that are within that. So.
Cool. Okay, estate planning and wealth transfer. Again, I know the demographic of the invite for this particular seminar is for those that might be on the younger side, but you might have parents or aunts and uncles that are a bit older and a bit more focused on estate planning and how to transfer wealth from one generation to the other. A few things. Basically, again, the 2017 tax code had doubled everything in the estate and gift tax exemption. Generally speaking, what that means is if the tax code had not been passed in this OBBBA bill, everything would have been about half of these numbers for what is on the screen. So instead of a $15 million exemption, it would be a $7 million exemption. In the meantime, and that's per individual. So a married couple gets a $30 million exemption, and that's an index for inflation. Everything above that, taxed at 40%. The thing that is often not talked about, but perhaps the biggest benefit of leaving assets. So think highly appreciated homes, stock that has gone up. I know we're in the UPS, Humana, GE market in Louisville here. So there are people that have accumulated a lot of dollars in their stock purchase plan with little to no basis. So the reason they've been holding on to it is that if they leave it in their estate, and their estate's less than the 15 or 30 million dollar threshold, their heirs get to receive those assets as if they paid the amount that it's worth on the date of death. So if you have a stock that you bought for $5 and it's worth $100 at the date of your death, your heirs get basis and can sell it essentially tax-free at $100 or whatever the market value is on the date of death or 6 months after. And that gets to be really complicated. If you use the alternative method, at the end of the day, these are what attorneys and CPAs are for, but there is a strategy there to hold highly appreciated assets. So what that also means is it's a really bad idea, generally speaking, to have mom and dad give away or do a quick claim deed of their house to make things easier. And we hear this all the time. Mom and dad just titled their accounts over to us, or they titled the house over to us. And we say, well, unfortunately, we have bad news in those circumstances. Whatever your mom and dad paid for it came with the gift. So it's important when gifts are being made that you consider the step up in basis versus gifting highly appreciated assets versus gifting cash or something that even might have a loss. At the end of the day, the other thing that is also misunderstood that is still a part of this bill is the annual gift exemption amount. That is still capped at $19,000 per person per year. So if mom and dad want to help you out with buying a house or help you with buying a car, mom and dad can give you $19,000 each, $38,000. If you're married, they could give that money to your spouse. There are legal consequences of doing that, but there is no tax. The other part of that gift tax exemption on that first bullet point is it's an either or. And the sum total of your estate tax and what you've given away over your lifetime, excluding this $19,000, can be up to $15 million. So if mom and dad want to gift you $100,000, they can do it all in 1 year. They'll use $38,000 of it doesn't count towards this limit. And then the other $62,000 will be a part of their gift tax exemption. They'll file a gift tax return. That doesn't mean it's taxable, but until they've given away $15 million each of gifts, none of the gifts are taxable. The other thing that it impacts is the estate tax threshold. So if you start using your lifetime gift exemption amount, it reduces how big your estate can be. So you can't give away $15 million and then turn around and have a $15 million estate on top of that and expect that estate to be tax-free. If you give away the 15 million, it's taxable. So it's not like there's some big loophole there, but at the end of the day, this estate planning component of the bill provides a lot of flexibility to people who have appreciated assets, whether it be you on this call or somebody that wants to benefit you or somebody that you're eventually looking to benefit. But we do encourage people who have larger estates to look at the annual exclusions and the lifetime gifting strategies. And we meet with you and your attorney and your CPA to go over those. So.
All right, so we're gonna touch back on some of the tax breaks for businesses. So the QBI deduction, and that's basically the qualified business income deduction, was made permanent. It allows for up to a 20% pass-through income protection, if you will, for smaller business owners. R&D deductions were also made permanent. In that case, they still must be amortized over multiple years, but some of the features that were initially enacted several years ago were going to expire and make those costs a little bit more expensive, a little less tax protected. But those changes have been made permanent as well. The higher deduction limits for what we call the Section 179 expenses, and those are basically just business investment, but there are higher deduction limits made permanent for that, which allows businesses to essentially save taxes there as well, and of course individuals with pass-through entities. And then finally, when it comes to qualified small business stock, and this is a situation where maybe a small C corporation is investing into another business. Asset limits for participating in this type of situation have been increased. Exclusion limits have been increased, and this is a more complicated investment scenario that most people are not going to be familiar with. But if it is something that you believe does affect you, there are certainly some additional benefits here that we should probably discuss. And some of the big changes there as well, they were either created or made permanent, or the 5-year capital gain structuring, where, as you can see, 50% gains protected after 3 years, 75 after 4 years, and then 100% after 5 years. And again, this is really just, broadly speaking, a way for businesses to save taxes when they're investing in companies, and for other smaller businesses who are looking for investment to get some funding. It creates a tax incentive for that situation to happen. So just again, opportunities there that we would love to discuss with you if you are a business owner and you're either looking to invest in other businesses, or if you're looking for funding as a business.
Great. One of those investments that we were discussing is the investment incentive programs. We have the QSBS, which is the qualified small business stock, which allows exclusions for investors in qualified US C Corps for up to 15 million for early exit gains. So one of the other big changes for that is the Opportunity Zone, which was a really popular incentive program. Sorry, I just was trying to introduce that, but I'll let Greg go from here.
No, I think you're good.
All right. So what we're doing with the sorry about that. So we're restarting the rolling 10-year timeline, so that in 2027. So that allows the ability to help you, after you hold it for 10 years, to then be able to see additional incentive programs, which is that you can defer capital gains, and you might even be able to exclude future gains after the 10-year hold period. There's special incentives for rural areas, which go through 2033. And that includes a 30% step up in basis for anything that's held for 5 years, at least 5 years. So that allows you, in case you're unfamiliar with step up, basically if you invest in a certain amount, if you hold it for 5 years, the capital gain between when you invest it and when you sell it, that's what the difference is, and that's the capital gain. But you can increase what your base is. So let's say you invested $100,000 and then you go to sell it for $300,000. That's a $200,000 capital gain that you need to pay tax on. The new incentive program allows you in rural areas, after you hold it for 5 years, that your initial investment will be $130,000 as opposed to that. So which gives you 170. So you save some on taxes there. So if this does pertain to you, there's a 10% on traditional opportunity zones and 30% on rural. And there's some really great tax deferral and tax advantage growth that can happen here. So if this does pertain to you, we're happy to talk to you more about that. And also just kind of evaluate what opportunity zone funds might be part of your investment strategy.
Okay. So that covers a lot of the big, beautiful bill act changes. Some other things that are coincidentally happening they were actually passed during the last administration, were included in the Secure Act 2.0. I think the Secure Act 1.0 was passed in 2019. Secure Act 2.0 was passed a couple of years ago and phased in a couple of major clarifications and changes to retirement plans. The first one being for anybody making more than $145,000 and over age 50, your extra contribution to the retirement plan is going to have to be on a Roth basis. So you're not going to be able to save that extra $7,500 or so on a pre-tax basis if you're over 50 and making more than $145,000. Has to be on a Roth basis. What that really means to those people that fall into that category, you're going to have to pay tax on $7,500 more, whether you save it to your 401k or not. If you're 60 to 63, there's an extra catch up. This gets really complicated really fast. Just know that when you reach age 60 to 63, you're allowed to save 150% of whatever the extra catch up is. So that's all I'm really going to say about that. Doesn't apply to a lot of people on here, but there's an extra catch up. And that's really tricky depending upon how old you are, because it doesn't continue out until you stop working. It's just for a 3-year period. And then if we go to the next slide, this is the one, there was some back and forth on who was going to cover it, so I'll just go ahead and cover it. There's a new automatic enrollment in 401k plans and 403b plans. There are some extra incentives your employer can give you to participate in retirement plans. And there are some new plan provisions that may apply to a lot of people on this call. So everybody's heard of a hardship withdrawal or emergency withdrawal. And, there's some rules around what qualifies as a hardship. There's also now a maternity related withdrawal option where you can take money out. I believe you have to pay it back over a period of time, but it can provide you some flexibility. And the thing is that your employer actually has to adopt that provision. So you're going to see a lot of employers over the next 12 months sending you notifications, hey, there's been a change to your plan. It doesn't look like anything's changed, but a lot of what they're doing is adopting these extra provisions that are, some of these are optional, some of them are required. And then for the older crowd, your RMD rates or age, it used to be 70 and a half. Now it's 73. And in a few years, you're going to have to start taking distributions at 75. I didn't cover this before when I was talking about 401ks. But it used to be that there was a required minimum distribution applicable to your Roth IRA, Roth 401k, excuse me. That no longer applies. So that's another change we missed covering earlier, but got it right here. So that's all I got.
All right. So overall, what does this mean for everyone on the call? More savings power, certainly for individuals that are nearing retirement age. And I know that may not impact a lot, as we mentioned before, but it's certainly something to still be aware of and take advantage of if you are nearing, that age range. Other catch-up strategies, other deductions that have been put in place or made permanent. Certainly things that you will probably want to speak with your advisor and take advantage of. The charitable deduction, for example, even if you don't itemize that could be a big opportunity if you give a little bit here and there to still get some tax benefit from. Deductions for taking care of someone else who might be in the household that didn't exist before, higher child tax credits and so forth. So again, work with your advisor, work with your CPA, ideally us, right? to really look at your specific situation, either individually or as a family, and let us kind of model how the different things in here will impact you, and really come up with the best plan forward, so that you can maximize, your either your business income, your personal wealth savings, you minimize your taxes, whatever that looks like for you.
Okay, great. We do have a few questions that came through, so I'll read those off, and most of them are surrounding taxes. So I'll just let maybe Chris or Greg, if he's feeling like he knows the answer better than Chris, our tax specialist, he can jump in as well. But the first question is, should I reach out to my tax preparer now, before tax season, to discuss how these changes affect me and my financial situation?
Yeah, I'll take that one, Greg. Absolutely. Ideally for tax planning, we want to be proactive, right? We want to position, or at least help position you to take advantage of, every strategy possible. When it comes to, next year, early 26, for example, and we're looking back at 25, certainly there are going to be some things that we could still do depending on, the time of year and the strategy available. But you might also miss out on some things that really needed to be done, or at least began before the tax year ended. So yeah, I would say don't wait. The earlier, the better. Absolutely.
And just to piggyback on that, let's not confuse tax preparation with tax planning. When you take your stuff to go meet with your tax advisor, your tax planner, you're really in the February to April timeframe, you are getting the most diluted version of whoever that person is. They are overworked. They're trying to get a year's worth of work done in really 2 months' time. And the fact of the matter is, what they're doing at that point is they're preparing what already happened. The large part of your tax prep, or tax compliance, as we call it, is really just documenting what you already did. There's very little optionality at that point. And the fact of the matter is that's what, there's not much you can change at that point. Right now, you still have not quite 3 months to throttle your income one way or another going into next year. And Chris and Cayman and our team right now are doing a lot of, for our clients, are doing a lot of modeling of, this is what you did in 2024. This is where we expect you to land in 2025 if you do nothing. And here are some things that you might want to think about, both in tech in 2025, but also in 26 and beyond. And back to what Pete touched on, that's where we're seeing was the biggest individual change from my perspective, is the charitable giving. We have a lot of people that are very generous on an annual basis with various charities. And there are a lot of changes, in the pipeline that may impact your situation. We're setting up donor advised funds. We're talking about, pulling forward some of those donations, or, changing the donation source to something like highly appreciated stock, going over all those rules. So you can't do that between between January 1st and April 15th. These are great conversations to have now. Good question.
Great. Another one is, are the charitable contributions for in-kind or only financial contributions, i.e., for example, goodwill donations of clothing or furniture?
I'm sorry, I didn't quite understand that.
So they're
I think
asking if charitable contributions are like in-kind in terms of actually sending stock, or if it's financial contributions only, meaning like if you went to Goodwill and dropped off clothes, furniture, and got that slip, and then we're trying to itemize it.
Yeah, gotcha. Greg, you look like you want to say something, or?
Yeah, I was just going to say, I think the question might be specific to 2026 going forward. and the $1,000 non-itemized deduction that you can take has to be in cash. I believe we can fact check and follow up on that one. But it won't count goodwill donations against that $1,000 cash contribution deduction per person. That may be the question. Otherwise, I believe, to take the goodwill in kind donation, I believe you have, or stock donation, I believe you have to be an itemizer.
Okay, great. Another one is if Congress modifies or rolls back parts of the OBBBA, how would that impact my filings and how do we plan for that uncertainty?
Well, I'm not really aware of that being a possibility at this point. I mean, certainly anything I suppose could change at any point, although, it's obviously a big deal to change, something such as this, and it's, very politically a hot potato. So it's not something that I don't think is just going to happen in a matter of weeks. But at any rate, I mean, we're always available to model, whatever situation is going to unfold, similar to, in your own personal life, whether it doesn't have to be that the tax law necessarily changes. Maybe something changes for you personally or as a family. We would simply just sort of remodel, if you will, how that's going to impact your path, your plan, your tax savings, and so forth.
Yeah, I think it's just like any other financial planning question. The second you come up with the plan, it's based upon assumptions, and one of those assumptions is going to change. So, I don't think there's anything you can do right now.
Okay, great. Another question is, I think that Peter mentioned it earlier, but how can I go about meeting with both my advisor and CPA, which is a great question. If you're in your financial advisor meeting and you want, and we should be talking about your taxes anyway, but if that is something that you want to do, I'll just or Greg will get your CPA's contact info, and we'll make sure we do an email, loop everybody in, and figure out a time that works for that. And then obviously it's a little simpler if you are working with Somnio CPA currently, to make sure that one of the tax specialists are in the meeting with us. If you are looking for a change or a new CPA, obviously Somnio Wealth is available and would be a great opportunity to make it kind of a little bit synergistic and make it a little easier to go through all the tax planning. Okay, and last question is there a benefit to a trust versus a will from a tax planning perspective?
That depends. And everybody needs a will. Some people need trusts. I will tell you that a lot of people that have trusts that are irrevocable, those get very complicated and can have a lot of unforeseen tax consequences. If you're doing a trust for Medicaid purposes, as an example, and you gift the assets into that irrevocable trust, the basis went with it, so there is no step up in basis on that. I say that, and these words become really important, just like earned and unearned income are treated differently. Irrevocable and revocable trusts are very different. Everything in a revocable trust is generally going to be taxed just like your will. These are general rules. Again, we would have to get down into the specifics, but unless you're applying for some sort of creditor protection while you're still alive, a revocable trust and a will are generally going to do the same thing from an inheritance tax perspective and or a step up in basis perspective. But the devil is totally in the details, and that's where you have to get really specific.
Okay, great. Again, another question for to ask your financial advisor and talk to them specifically about. So as it relates to your individual case. So that's all the questions that we had. I don't know if anybody has any last minute thoughts. Or if you do
Yeah,
have any
just
additional questions, just go ahead and email your advisor.
Chris and Pete are great resources. Thanks, Haley and Kelly, for helping organize this. And until next time.